Yeah, thanks, Fuzzy.
Hey, everybody, we got another one. I will let you know, nobody has ever actually quit on that. Nobody's ever said, that's it, I'm out. So they always go forward, but
You're giving
I kid.
out. That's okay.
Yeah, I kid. Well, let's really start the episode here. I love to start with, first off, let's do a little 90-second pitch. Who are you? What's your company? And what do you guys do?
Great. Well, thank you. My name's Matt Venturi. I've been on Wall Street my whole professional career. Started with Merrill Lynch in a corporate intern training program. There were 17 of us that went through 18 months of training, 2 months in each area. The firm was great accelerated training. I went to NYU Business School at night while doing that. Became a retail broker at the end of the period, which in retrospect now was probably a great experience. I eventually ended up on the syndicate desk, pricing debt issues, investment grade debt issues with Merrill. Ended up leaving, going to Salomon Smith Barney, investment banking, 12 years there before doing financial restructurings, bankruptcy advisory, and then ended up going off on my own. I built a small boutique investment bank doing private placements and restructurings. Then I got recruited by Houlihan Lokey, Howard Zook, and a middle market investment bank that needed to build up their investment banking efforts. Did that for about 3 years and then went back on my own. But I co-founded a company, ClearingBid, which we'll talk a little bit about maybe here, which is democratizing the IPO process for most investors. Kind of a revolutionary idea. I think that the market is really ripe for it.
That's amazing. So obviously you've got a big history here in the world of Wall Street, a lot of background, a lot of insight. So what's this aha moment that says we need to fix the IPO process and turn this into ClearingBid? So what is that sort of origin story there?
Yeah, it was really a culmination of experiences, but I think probably Fuzzy, the one sort of epiphany I had was having worked in virtually every part of the sales side. It's really, you get the buy side and sell side, but syndicate, sales and trading, corporate finance, really the research and aftermarket support for issues. But really how an IPO gets done is so conflicting. I call them silos because each of these areas, different disciplines in the sell side, are highly conflicting. And they each have their own kind of, priorities that they adhere to. And consequently, it's very conflicting. So I stepped back and said, geez, this is just such an antiquated, opaque, and highly exclusionary process. How and what is being done to try to do something about it? And it really goes back to the old days when W.R. Hambrick and the Google IPO and Dutch auction started, but evolving from that point is kind of where we are now.
Yeah. How do you sort of dumb this down for an average listener? What's that sort of like 90-second pitch of how you say, this is what we do so that, the common person understands it?
So today, a lot of people would love to have the opportunity to invest in an IPO. They tend to get priced at one level, say $25 a share, and then they open up at $50 a share. So on one hand, the companies that are leaving that money on the table, that's a cost of doing business. And also for investors who would love to be able to buy shares and own and hold shares in companies they know and love at $25 or some thereabouts instead of paying $50 is, would be revolutionary. So what I'm saying is, hey, look, allow the companies to access a broader investor base with the broker-dealer community that services them and give everybody the same opportunity to get into an IPO at the same time that the big institutions have had the privilege of doing themselves. And it's going to allow more companies to raise more capital and more investors to have opportunity to build wealth over time.
Yeah. Yeah. So for our listeners out there who have never seen this, don't know any background, how do you sort of describe what is happening maybe behind the scenes with the algorithm and with your software and stuff?
Well, you have 10 patents now on what we developed, 4 allowances pending, which means we'll be forthcoming. So we'll have 14 patents. And simply the algorithm, which really is, they call it a system and method, but it plugs into the existing infrastructure with how orders today are sent to an exchange. So we follow the same pathway so that every order that gets submitted is recognized. And in the end, every order that's in the money, in other words, if you make a bid at the IPO price or higher, you're going to get filled. And that fill rate or that allocation that you're guaranteed to get, no matter if you're an institutional investor, a retail investor, a widow and orphan, doesn't matter. Everybody has a level playing field. That allocation is based upon the timestamp on your order. So it's price and time, just like the secondary market. And that's what really inherently part of the algorithms and the patent covers there.
That's great. That's great. So yesterday we talked, just for our listeners out there, we actually talked yesterday and you had a couple buzzwords that I actually wrote down and stored into memory. One of them, you kept using the concept of deals are sold, they're not bought. Can you walk us through that sort of concept and what you mean by that?
Yeah, it's funny. I think right now there's this real push to try to get retail investors to the party, and there's folks that are facilitating that. But, when transactions are, hot, everybody wants it. But at the end of the day, who's to say what's hot, what's not? This price discovery tool is really important. So that's one thing that you really want to have is, how do you really gauge price and demand? But when you ask about deals are sold, not bought, I'm a huge advocate of providing investor oversight, investor protection, which is really what the broker community and registered investment advisors are responsible for doing. Fiduciary standards, best interest standards, and the ability to have that sales force educate, inform, and engage with their client base to facilitate the sale of a security is really important from my standpoint. Because from one perspective, the SEC wants to see the underwriters have exposure, underwriter liability exposure. But at the same time, the brokers provide an important role. And this is one of the challenges we talked about with crowdfundings. And crowdfundings, they're really not sold. They're sort of posted up there to be sold, but there's no one really selling.
Right. Yeah. So what happens, I guess, in this space? Where do broker dealers kind of fit in? What are they doing? Are they would they be happy about this? Would they be nervous? Like how would they be feeling if they started to use ClearingBid in their workflows?
Well, today, there's a high concentration. 80% of the deals right now are underwritten by the top 5 firms, the bulge bracket firms. And so consequently, most, if not all, the middle market firms are really excluded from participating. They may have their name, in the syndicate and underwriting group, but they're not getting any allocations. What we're doing is we're saying, look, every one of those firms has relevance. Every one of those firms who services their client's interests should be able to participate, and every client that they work with, every investor should have the same level playing field. So what we're saying is, look, we want to bring those middle market underwriters to the party, and we want to allow them to earn the commissions, because commissions don't come out of the customer's pocket. They come out of the underwriting spread, the placement fee, if you will, the issuers place. And the flip side is the issuers are leaving a lot of money on the table with the way the pricings take place today, and then the aftermarket pops. So if we could take a little bit of that out, pass it along to the investor, but also pay the salespeople to step up and sell, it's a win-win for everybody.
Yeah, it really does sound like it. How do you guys think about collaborations, partnerships? How are you sort of kind of laying the groundwork for those over the next few years here?
It's an education, Fuzzy. We have 5 constituents we have to deal with. The issuer, they have to use the system the same. We want the underwriter to use it. The underwriter has to adopt it. It's a pricing tool. The brokers have to understand how to place orders. The investors have to be educated on use, and the regulators have to sign off. So we've got kind of herding cats. We got all these different constituents we have to appeal to before our first transaction. But the flip side is every single one of those constituents in this ecosystem benefit. We could cast a wider net for greater participation. There's the price discovery. There's the equal and level playing field. There's regulatory compliance. So it's truly revolutionary, but historically it's been just a very exclusionary and highly discriminatory process for the benefit or to the benefit of just a select few. And we're just, kind of breaking down those barriers and say, look, the market's changed. The internet is a great equalizer. Let's utilize the technology and the infrastructure that's there that has the integrity, and let everybody, be a beneficiary of it.
Yeah. I'm wondering this, you might be the best person to ask. How does an infrastructure like what we're talking about get built over I guess maybe does it start in the 20s, the 30s? And is what happening is that we're just keep stacking and stacking and stacking. At some point, you're like, all right, we need either a whole new system, or we really need a massive shift in how we do things. How does a mechanism or a world like this get built, to where we are right now?
Well, a lot of it, I think, is regulatorily driven. When, Wall Street, I always say they're smarter than your average bear, kind of take advantage of loopholes. And Glass-Steagall was one, and regulated NMS to make sure that the best price is executed on behalf of the investor when they want to, place an order on the exchange. Certainly decommissions and what's happened now to the extreme that, investors don't pay any commissions. I think the evolution has kind of driven ultimately the creativity. What's happened now is, you have different competing alternatives for going public. You have direct listings that kind of came, and, they're struggling a little bit. You have SPACs that, have had their own challenges. So there's different ways to kind of access the capital markets. But, now there's this big push in the private market. You really have to ask yourself the question, is there the same kind of disclosures and protectionary measures that I think the regulators are starting to take a harder look at, even though they want to let these 401ks invest, et cetera. They know that lack of liquidity, lack of disclosures is an issue, and they don't want investors to be taken advantage of.
Right. Let's move over a little bit to actually your fundraising. So the reason we reached out is that I found you running a Wefunder campaign. I'd love to talk a little bit about just maybe some of the goals, strategies, and how you've been raising capital for yourself, and then maybe what the milestones and future looks like.
Thanks, Fuzzy. Well, we started really friends and family, and I personally made a big investment in this company to get the thing started. So we went through a couple seed rounds, which ultimately probably represented a little more than 5 million. And then we did a crowdfunding 2.5 years ago with Wefunder. We were extremely successful. It sold out in less than 3 weeks, raised 5 million. Again, that's because we had some promotional efforts from some research coverage here. Jeff Brown, who helped us out with that. And that was a big contributor. We then raised some additional funding because our first IPO that was filed last year didn't go through. The underwriter pulled it because of the market volatility, and that kind of set us back a little bit. So we decided to go back to the market. We're doing a smaller crowdfunding raise right now with Wefunder for $618,000. It's the most you can raise without a gap audit, which is fine. And we're supplementing that with a Reg D private placement. But our intent right now is to be in the market by the second half of this year with our first couple deals. We're laying the groundwork right now. We're pivoting a little bit with the use of these proceeds to have more scalability, more reliability, more connectivity, because you have to be able to connect all these firms in the streets so they can seamlessly put orders in. And that's, part of the trick. But it's all existing infrastructure, and there's no technology risk. There's no execution risk because we've already tested, built it, proven it. And we think we've got, a pretty solid case to get out there. And no one, to my knowledge right now, seems to be touching this area.
Yeah. Let's talk about this go-to-market with a 5-sided sort of coin of education. How do you break through, and do you really test this to say, this is working, this isn't working, we got to fix that? What does that look like behind the scenes?
When you're an entrepreneur, you're kind of a champion, and you have to sit there and be the cheerleader with how you organize and manage the business on one hand. But the ability and requirement to think forward in terms of strategy, it is as much kind of intuition as anything. So I rely a lot upon my prior experience in Wall Street, where I think, there are some deficiencies that we can address. And then 2, where the market seems to be evolving with now, say, more, retail brokerage participation and different types of asset classes. People want to participate at different stages of companies' evolution. So like the secondary markets right now, for privates, that's been a big boom and there's a big push. But, I think right now the real benefit is to take advantage of the public markets and provide that as a way in terms of the access. And that's kind of where our focus right now is to exploit that and make that available to truly allow people to build wealth, with the kind of transparency and access and fairness that, everyone deserves to have.
Yeah. Yeah. Now, yesterday you mentioned doing a little bit of work with Senator Chris Dodd, I believe, right? On regulations and stuff. Do you feel like right now the winds are pushing against you, or they're in favor of what you're building, where you are right now, and just how do you feel like the landscape is right now?
Well, we spent a lot of time on Capitol Hill. We met with more than 24 representatives on both sides of the aisle in the House and the Senate, and it was extremely well received. Senator Dodd, who I have the utmost respect for, who believes this will bridge the wealth divide in America, has been a huge advocate. And he, I think in many respects, helped open up some other doors for us to really expand on initially the SEC's view. So the SEC, back to your question, they have 3 mission statements: investor protection, which we're providing particularly with the broker oversight, fair, orderly, and efficient markets, which we mitigate that aftermarket volatility by avoiding the big swings, but putting shares or securities in the hands of the people that want to buy it in the first place. And then the other is facilitating capital formation. There's more than, according to Bain, there's more than 31,000 private companies out there with $3.7 trillion of unrecognized gains. And a lot of these portfolio companies and private equity funds and venture funds have been sitting around for quite some time. So there's a demand for liquidity. There's requirement to kind of do that in a way that is efficient. And I think back to your point on Capitol Hill, there's a lot of support. So maybe now, with the SEC suggesting and reviewing to go semi-annual reporting versus quarterly, that's a positive, I think. Less rigorous, more practical ways and less costly ways to get to market. There's also, a movement to maybe change under the Jobs Act revisions, the the Regulation A 75 million cap to maybe raise that to 150 million cap, whereby companies can go out and, raise a little bit more money, have a little bit more institutional participation, but it doesn't have to be your multi-billion-dollar deal because, a lot of companies can justify that. So I think there's some real, we got some wind in our back right now from a regulatory standpoint that should work out well.
That's great. I like to focus just for a second on that Reg A, because I've been a part of these conversations in my world is whether or not the ceiling needs to be raised, doesn't need to be raised. How many companies have even raised 75 million? And there isn't just isn't that many. I guess walk me through what you think would happen if that ceiling were to be raised to, I think it's what, 150 million, I think is what they're saying. What would happen? What would you see? Put your glass dome in there and think about it a little bit. Like talk to us a little about what you think would happen.
Well, first and foremost, any company that's going public, has to be a high quality company, because I think these micro cap companies that get pushed through, and there's a whole mafia of how they get placed and who owns them, and then they sell. And, it's an ecosystem that is really suspect, quite frankly. So the ability to have more transparency and disclosures is important. But this Reg A plus is a fully registered registration statement. It doesn't require a PCAOB, Public Company Accounting Oversight Board audit. That's a real high standard audit. And the GAAP audit, which has been sufficient for many years, is sufficient for a Reg A. So the Reg A's, notwithstanding to your point, they're only 75 million right now. And the ability to raise that, I think, is going to encourage more participation among Wall Street firms and underwriters, because there will be more secondary market liquidity from the outset. And that's one of the problems, because our first transaction we were going to do was a Reg A, and the Wall Street underwriters didn't want to do it. And this is why you're just not seeing a lot of these get done. But the Jobs Act intent was to allow the ability to go down market and be able to facilitate a more costly, efficient, practical way to be able to get to market. But it still comes back to the quality of the company, and you just can't be bumping these poor quality companies out and expect to continue to do that and not have the investors push back and the underwriters push back.
Yeah, I think that's one of the things on mine. I think it would get rid of a lot of the deals that just shouldn't probably be raising, or they're just not at that stage yet. They just don't have the footing. Not that they're not a good company or they're not on a good path. They're just not ready for really crowdfunding in today's world of just what it takes. So I want to talk about that first raise. You had a good amount of investors that invested. What was maybe some of the narratives or some of the things that you might have heard from them, if you did or you didn't? Maybe positives, negatives. Just what did you hear from those first round of investors in that first Wefunder campaign?
I tell you, Fuzzy, it was pretty heartwarming to hear and see some of the responses that people had. I mean, one, we had a lot of people rooting for us and saying, "Hey, look, it's about time that someone come and democratize this process, give average investors the opportunity to invest and participate here." And so that theme was really positive. We had 3,700 investors come in. We had, I think, 267 that didn't make it in time. And in retrospect, I kind of made the of only posting quarterly and annual posts and updates to just the investors. And we've now got another 2,000 followers, and the light finally went on. I said, "Hey, look, I got to reach out to these people because they're following us. Why should they be excluded from the information?" So that's really a great advocacy group out there that I feel I want to engage with. I want to be accessible to, and I want to educate them. And it gets back to your earlier point, how do you get this education out there? And it's going to be, I think one of the ways it's going to be fun, you were talking about long form before. Years ago, I was doing in the golf industry, these infomercials, but it's information, it's education, and it's entertainment. And you need to have kind of the way to engage with these investors. And I think short vignettes and videos, and we wanted to kind of do that to really kind of educate and inform and entertain is going to be the way to create more engagement. So that's all kind of part of the plan.
That's great. Some of my listeners right now might be thinking, because this has popped into my brain, how do you make money? So if I'm investing, like, how do you guys make money? What is the system here? All this stuff sounds great, but how are you making money?
Well, there's three principal syndicate tools out there that are licensed platforms, and that's fine because they're basically been syndicated among the different Wall Street firms to use them. Our revenue model is a transaction fee, and we had to become a broker dealer with FINRA in order to get a success fee, or the equivalent of a salesman's commission when we complete a deal. So there's a higher standard of compliance that we have to go with. But every time a transaction gets done, we're clipping a toll fee. So right now, the model is 50 basis points, or 0.5% of the gross proceeds that are being raised. We actually have engagements that are 1%, twice that right now. But it's going to allow us to scale this pretty dramatically. And we're not picking the pockets of the underwriters. We leave the gross underwriting spread alone. We reallocate that a little bit to make sure that the salespeople are incentivized, but we also want to make sure that the underwriters are incentivized to show up. So we're leaving that alone. But again, we're taking a little bit of that significant pop out and transferring that to investors and not causing the company to incur the loss, or the hit. But at the same time, fee, I think, which is a very defensible one, is a low cost relative to the savings that we're really providing, the benefits we're providing to everybody.
Yeah, that's great. That's great. What's the next big milestone that you guys are making sure that you hit, just to make sure that the wind is pushing behind you and you guys are hitting these milestones? What's the next big one that you want to hit?
Well, it's one thing. It's getting the market with our first deals. And we had two deals, one that, again, fell on the PCAOB audit requirements that didn't make it. And then the other got pulled because of the underwriters. I think managing expectations for, timing and when we get to market, everybody says the same thing, Fuzzy. Hey, come back after you get your first deal. And we do, I think all bets are off, because we're not only doing this for equity IPOs, we can do this for debt. And the debt is a bigger market and probably, would be significantly a bigger grower. But so the huge, right now, everything's focused on third quarter, getting to market with our first, we'll call it proof of concept or minimum viable product. It's probably not going to be a huge deal, but we got a couple in the pipeline we're working on right now, and we want to refine that and continue to expand it and continue to market to issuer prospects to get those mandates.
Does anything on the tech side switch to debt if you're doing that type of deal, or is it basically the sort of the same back end workings?
It's a good question. So with equity, you have to leave a little bit on the table. You want to pop,
Yeah.
You can sell the whole offering at $25 a share, but you end up wanting to price it at 22. So there's twice the demand. 22 is a better price because there's unmet demand that's going to make it go to 25, 28, 30.
Right.
The debt, you don't have to leave a pop. You can basically market and say, okay, we're going out and raising a $100 million or $500 million offering. And at the end, okay, what's the lowest coupon that we can get that interest cost down to still sell 100% of the offering? You don't have to leave. You don't have to be able to establish more demand than supply. As long as you hit that mark, we're going to lower the cost for those issuers, and we're going to allow the investors to come in a quality investment grade paper and be able to supply that with, I think, a reasonable amount of regularity here, but with full disclosure. And the key there is all about price discovery. It's letting people know, what's that demand look like? Where's it look like it's going to come out, instead of being over behind the curtain and not telling anybody and letting them try to figure it out on their own and then finally price it. And you're either in or you're out. Most people are out.
On that debt side, does that shift anything? I talked to a lot of companies actually on Main Street. In fact, one of the events I'm working tomorrow is more of a small Main Street type companies. Is there any play for this, or are we still talking about bigger companies looking at the debt play in this?
Yeah, I'll tell you, just roll back the clock. We was involved with some of the first franchise financings, and this was with Burger King, Taco Bell, even Blockbuster. And long story short, we would pool $100 million of loans of individual franchise stores and get a credit rating. And we were able to sell these asset-backed notes that were investment grade and giving the borrowers a lower cost of funding that was non-recourse, accessing the public markets with the securitization structure, and allowing, what today, we talk about these business development corps and the shadow lending and the Apollos and the Cliff Waters and all these guys are out there, making these loans. Those are generally pretty large loans still, because they're being syndicated, they're being aggregated, and they're being, some are being securitized. But I think there's going to be an opportunity to really go a little bit more down market, but good quality underwriting standards, and then be able to, you still want to be able to, you need to rate this paper. I mean, it needs to be investment grade. But I think at the end, the ability to educate the market with the fundamentals and the creditworthiness and the ratings and the background information, that's going to be important. And that's part of our whole portal and how we face with the public, because we push that information out there for everybody to have access to it in a real-time, consistent basis.
Yeah. I wanted to wrap up because I got a couple more questions here. Just on the one, I want to talk about the investor using. What does that look like? What is that interface? What are they doing? Is it something that they're checking all the time? They're coming in once in a while. What's the world look like for the investor participating and logging into your system?
Well, we have a tutorial now we just released. It's about 11 minutes. So I would encourage people to, take snippets of it, but it does go end to end and basically demonstrates or illustrates how on the public portal, as an offering is coming to market, you can track it. You can see the price and volume and demand. You can see if your order that you put in is in the money. When you put your order in, you know what your timestamp is, and you're going to know what we call priority group, or where you are in terms of that chronology, being that earlier orders are going to be entitled to a larger allocation, because that's building the price discovery, which then we display publicly and everybody sees real time to the nanosecond, along with the ability to click on the prospectus, click on the roadshow, and click on to your broker and be able to put your order in, just like you're sending an order to the New York Stock Exchange today. Your symbol, number of shares, and your price. Everything's ubiquitous. Everything's seamless. Everything's the same as if you're buying shares on an exchange.
That's great. That's awesome. Where can people dive in? Let's say they want to learn more. They want to kind of just start investigating. Where should we send people?
Our website's a good starting point. We're redoing a little bit of that. We have what we call the IPO Data Hub, which basically is a report card of how atrociously priced these companies have been, which is kind of educational. We've got some chat functionality now to help. We also have this tutorial. And then once we come to market, we're going to be coming with a lot more content because we're going to have push messaging so that people can, make sure they're up to speed with deals as they're coming. They can log in and say, I want to track this particular issue. So we really want to create engagement. And all that is kind of part of what we call the knowledge hub. It's all about education and engagement and being a, kind of an independent, agnostic resource of choice for folks to be able to utilize and give them what I think they deserve.
That's great. Well, Matt, I appreciate you taking time out of your day. I always love getting in the weeds on these types of conversations. Usually I'm pretty top level on some stuff, but this is really fascinating. And I think what you guys are doing would be a game changer in terms of just fairness and insights into this IPO world. It really is fascinating. So for all my listeners out there, I'll have all the links in the show notes like I do for every one of these episodes. Go click around, go connect with Matt. I'm sure you guys can jump in and point in different directions here. But Matt, I appreciate you taking time out of your day. Thanks so much for your time.
Thanks, Benji. Sure appreciate the opportunity. Take care. Thank you so much.
Thanks.
Bye-bye.